It's the economy. Joining me now is Diane Swonk. She is president of DS Economics, and great to have you on the show, Diane.
Oh, it's great to be here, Angie.
Let's talk about the economy, and especially where you see weakness and strength. Now, a lot of people are concerned about what's going on with retail numbers and consumption. Those numbers are looking weak, but what do you have to say about that?
Well, if you just add up the straight numbers that come out from the government, you're going to get a GDP that looks like about 1% in the first quarter, which is a deceleration from the first quarter, and it looks absolutely tepid at best.
And people are worried.
And they're worried about it. The problem is, and we've had this big divergence between what's going on in employment and what's going on in the measured GDP numbers. But what we know is, and I have enormous respect for the statistical agencies of the U.S. government. They try very hard, but they've been strapped for funds, they've been starved for funds, and they just can't measure accurately some of the retail sales out there. And the biggest example is the Walmarts, the Costcos, the Sam's Clubs of the world. They sell gasoline as well as other stuff. The problem is it's not separated out as gasoline sales, so when gasoline prices go down and the volume of their sales look weaker, there's no way for the government to sort of adjust for that. So it means that we're seeing weaker retail sales than actually is occurring. And people who are arguing that there's not an oil dividend are missing it because we're not adjusting the data correctly.
So what will that mean in the long run, though? Because if we do have stronger than being reported retail numbers, there's sort of a pessimism right now about the economy, and a lot of people are pegging retail and the consumer.
Exactly, and this is one of the issues about it gets into policy making decisions. The quality of the data really matters. Now, the Fed has often said, we're not sure that we're adding up. Remember, we started these GDP statistics when everything was products, not services. That's why it's called gross domestic product. So, of course, it doesn't actually measure the economy. There's actually one line I was looking at in investment for telephones and fax machines. Kind of antiquated in our measurement.
Just a bit.
Yeah, and how we think about the economy. So, they're desperately trying to catch up with a moving target. They've also really been starved, and data is just one of the most uninteresting four-letter words in Washington. And so trying to get people to actually pay attention to data and the fact that it's discretionary spending, and that's what's been cut in recent years, we've compounded these problems. But it does mean that you can make wrong decisions on policy as well.
Where do you place GDP, and what is your forecast?
Well, I'm looking for 1.1% because I have to add up the data that comes out from the government. I think underlying growth is actually a little stronger, and this consumer is playing more of an atlas than we're giving it credit for because we're not capturing it all accurately. That said, we need a lot stronger growth. I mean, even if we got to 2% and say it's, the economy is really 2% instead of 1%, that's not gangbusters. And it's still not enough to make people feel good about the economy.
What is this saying to the Fed, and what is your perception of the Fed moves and the potential of moves this year?
Janet Yellen certainly came out this week and caged the hawks, let's say, and I think it's really important to understand that she's looking at the economy, and it's not just GDP. She's looking at labor markets, and she's saying, yes, they've improved. I appreciate that. But she hasn't seen enough traction in wages. And she's a veteran of the 1990s. She remembers when anyone with a pulse could sort of get a job. And there's this sense where she feels we could maybe overshoot, go low on unemployment, and re-engage some of these workers and maybe regain some of what was lost in living standards. And that's, part of the reason why she keeps pushing the hawks back to the sidelines. She also has legitimately stated there's some risks out there. We keep saying that oil prices are transitory, the dollar is transitory. They've been transitory for 2 years. How long is transitory permanent? And it could come back again and haunt us with lower inflation. So she's willing to stay on the sidelines a little longer.
We've also seen the Treasury have some issues as well, and I know that the Fed is watching inflation and the 10-year below 2% here. What is that telling you about inflation and the overall economy?
Well, certainly, I think it's a couple of things that we're seeing in the Treasury. One is it's a flight to safety in the Treasury market. We've seen that internationally. But two, there really is, the Treasury market isn't expecting a lot of inflation out there. Now, they tend to be very short-sighted on that, and so I don't like to put too much into what that means about the forward-looking and just the role that the U.S. Treasury market plays in the global economy. I think we can overinterpret what that's telling us about our own U.S. economy.
Diane, wonderful to have you here, and I hope to have you back soon.
Of course, Angie.
Thank you.
Thank you.